In today's video, we're going to share 3 of Lake Road Advisors' core investment principles. At Lake Road Advisors, we have a set of principles that serve as the foundation for our investment philosophy. Today, we're going to share 3 of those that help guide us when we decide how to invest our clients' portfolios. The first principle is the idea of passive over active. Now, for over half of my career, I spent time on Wall Street working in institutional equities at Morgan Stanley covering hedge funds. And for the longest time, I did believe that these hedge funds had the ability to outperform or create alpha for their clients. Now, fast forward to where we are today, after a lot more research and for the firsthand ability for me to see what actually happens, really a lot of these managers can perform well for a year or two, but they don't have the ability in the long run to outperform their said index or benchmark. There are many data points that explain how, over the long run, the active or stock picking type of investor will underperform. One of those I'm going to share with you today is from SPIVA, or the S&P Indices versus Active Scorecard, which really highlights how in any one period you can show how the passive approach will outperform the active approach. Now, this example here shows in the US that over 77% of the time, the passive manager will outperform the active. Now, you can search this based upon any market or timeline you want, but the fact remains the same, that it's very hard for the individual active manager to outperform the passive approach. Core principle number 2, don't try and time the market. Now, the idea of timing the market or trying to buy right before you think the market's going to go up or sell right before you think it's going to go down has been something that has been proven over and over again to be a bad idea. Historically, there's a reason why day traders underperform, or I believe it's 80 to 90% of the time, lose money over the long run. There's no better example of how hard it is to time the market than this last year during the pandemic. The S&P 500 was down over 35% in just 1 month, yet for the entire year, the market finished up over 16%. Now, that's during a global pandemic. That's during a time when over 500,000 United States citizens to date have passed away. And again, would you have thought the market would be up in a year like that? I wouldn't have. Timing the market is hard. That's why we don't try to predict where the market's going. We invest based upon your goals, your own risk tolerance, and your time horizon. Here's an example of just how hard it is to try and time the market. If you look at this slide, there's a 7.43% annualized return over this 20-year period. Now, if you miss just the 5 best days during that time, your return drops by almost 2.5% down to less than 5%. Miss the 10 best days and you're down to 3%. Ultimately, it shows how the largest days of gains really impact your overall performance. So jumping in and out of the market, if you're missing some of these big days, are really going to hurt you. Third principle we're going to talk about today is diversification. Diversification really isn't that exciting, but it works. The idea behind diversification is one you've probably heard before, not putting all your eggs in one basket. Here, if you take a look at this ugly looking quilt, it shows you how by owning just a little bit of each different type of investment, whether it's a large company, small company, a bond, an international bond, a commodity, you are basically guaranteeing yourself of an average return in the middle. So by diversifying, what you're effectively doing is making sure that you'll never strike out or get the worst return. However, on the flip side, you're never going to hit the home run and get the highest return. When we think about investing, we think about wealth creation and steady growth on a risk-adjusted basis. Sure, we can try and guess every year and pick the best performing asset class or stock, but as we've shown you before with data, that's really hard to do. So what we want is the largest return on the best risk-adjusted basis. Again, by diversifying, owning a little bit of all different asset classes, we're lowering our overall risk level, and we're guaranteeing ourselves kind of a middle-of-the-road return, which ultimately is what we want. We want to consistently grow our wealth over time. These are just 3 of our investment principles that help shape our philosophy. If you want to learn more about our investing style, please reach out. We'd be happy to help.